I'm Darius McDermott from Fund Calibre, and today I'm joined by Nick Shenton and Andy Marsh, who are co-managers on the elite-rated Artemis Income Fund. Good afternoon, guys. How are you doing?
Very well, thanks, Darius.
Good afternoon, Darius. Good to see you.
Great. Hi, Nick. Hi, Andy. So, look, you are income fund managers, and one of the key things you look at when you invest in a company is the dividend that pays. Due to the dividends cuts following the pandemic in 2020, what's the outlook for dividends? Are companies already starting to replace and raise those dividends from last year?
Yeah, I'll take that, Darius. Yes, they are. We've been actually pleasantly surprised by the progress that a lot of our companies have made over dividends, certainly compared to when we were talking this time last year. You know, dividends were extremely challenged at that point as companies saw the uncertainty of COVID begin to really unwind. And I think we've spoken before that we actually categorised our stocks into three areas. Those companies that continue to sustain and potentially grow dividends through the crisis, those which were the hardest hit in the eye of the storm or indeed precluded by regulators from paying dividends, and those that deferred or delayed from the sense of prudence, or maybe were taking furlough and didn't feel it's appropriate to take support from government and pay dividends the other side. And it's really that latter category that's come through strongly over the last 6 months in particular. Our dividend was down just under 25% in 2020. That's against a market dividend that was down 40%. So I think our focus on our mantra on cash flow first has served us well. But as we're now coming through, obviously, what's been a reporting season for the full year for 2020, we're starting to see some visibility over growth for the current year. And we think dividends can grow at mid to high single-digit rates in 2021. So we'll be at or close to 80% of our pre-COVID dividend, which is certainly better than we were expecting 6 or 9 months ago.
So look, you touched briefly on markets there and that last 6 months, and I tend to think of it in terms of the vaccine bounce that we got in early November, which has led to a bit of market rotation. Growth stocks have dominated value stocks. Now, I know you're neither a value nor a growth manager specifically, but how have that opportunity and that rotation in the market played into your fund, not just from a dividend perspective? Maybe talk us through how you've seen that rotation in markets.
Yeah, I can take this one, Darius. And look, as you said, we wouldn't categorise ourselves as either value or growth investors. The truth is, over the 20-year lifetime of the fund, the key philosophy has always been about long-term cash flows. That's where we think we really can get an edge, not about what people might pay for a share based on short-term earnings multiples. And I'm relatively pleased to say that, as Andy pointed out, that the dividends were a bit stronger in the fund than we might have anticipated 6-9 months ago. And broadly, the relatively eclectic mix of cash flows that come from our 50 holdings enabled us to maintain pace with the market when growth was doing better and carry on when value's been doing better. So really, from that perspective, we're pretty agnostic, and the performance backs that up.
So has performance been better relative to peers in that last 6 months, or has it been just consistent?
I'd say consistent. We finished the year in 2020 up around 3% on the market, and we're ahead again in 2021. And we've done that in a pretty idiosyncratic way. We're very much our own people and our own thinkers, and the fund is like that, which means it's hard to categorise as I say, either growth or value. And perhaps versus the sector, it's delivered its total return aspirations of high single digits through the cycle over the 20 years or so of the fund. And it's done it with lower volatility than the market.
So is there any one of them, how the market would perceive value names or growth names, that you'd like to highlight that have either done better recently or throughout 2020?
As we say, there's been a reasonable mix. We can say that there's a number of companies where we are perhaps more optimistic about the prospects for the business and the cash flows as a result of the events of 2020, which might seem a bit strange to say given how hard it's been for so many businesses through that period. But what it's really done is it's forced businesses to engage with technology in a way that they perhaps hadn't been doing as aggressively as they might have done. And we actually think there's opportunities for a number of really terrific franchises based in the UK to use technology to create more value for their customers and stakeholders and capture more profits for shareholders. And that might be a business like Next, which is really pivoting from being a retailer of its own product to a marketplace for not just theirs, but other people's and going internationally. It might be a business like Burberry, which is getting much closer to its customers, both from new additions last year. Or it might even be a business, heaven forbid, like a Barclays, which has got some very strong technology capabilities in its payments business, which is not discussed, but we think perhaps over time could be very valuable. So the summary is really, we're trying to find businesses where technology is the thin end of the wedge, the commoditized part, and the brand and heritage and scale and customer relationships are where the value is captured.
You mentioned, you've fallen nicely into my trap there, thank you. You mentioned the word commoditized. So let's maybe touch on another area of the market, which is commodities. The other thing which is on everybody's lips at the moment is inflation. How are you seeing the market with respect to sort of inflation, and how is that affecting commodities? Is that a short-term trend, or do you think that's got some more legs in it?
Well, it's clearly a very topical area, Darius. Cost pressures generally out there, the impact on inflation. I can make a couple of observations on companies that we've spoken to in the last week or so. A couple of food companies in Europe that are seeing agricultural commodity primary products moving higher. They're seeing challenges around logistics costs, packaging costs, and we're also seeing it with the likes of, as Nick just touched on, Barclays that reported on Friday. They're seeing some wage inflation now as well in their investment banking business. So this is a very topical area of the market. But to some extent, some of this is pure maths in the short term. Bear in mind, at one point, about 12 months ago, the oil price went negative. Yeah. So to some extent, this is a comparative base. And I think we're not really agonising too much over some of these short-term drivers of inflation into the system. But what we are thinking about, again, as we always do, is that longer term and where we might see inflation become more persistent and more structural. And one of the interesting areas for us, I think, that we debated a lot as a team over the last few months, is the impact that this whole drive to being cleaner, greener, particularly around energy production and distribution, what that does for inflation, actually, because there's a cost associated with this. These things are going to cost in terms of investment that's required to enable this to happen. And we think that is something, an area of focus, and it is worthy of attention at this stage. And we've expressed that in the fund to some extent through increasing our exposure to some of the mining stocks, particularly those stocks that are extremely well placed from a resource and a metals in particular perspective to actually enable a lot of this investment in cleaning up energy to actually happen. So something like Anglo American, which is a business that's very strong in copper, and indeed some of the platinum grade metals that are really important in enabling us to actually produce and move electricity around that can replace some of those dirty carbon intensive current energy sources that are clearly under some pressure.
So finally, then, if I could ask you a question on valuations, but through the lens of M&A. When we spoke with Adrian last year, he predicted that M&A would pick up. Are you seeing that coming through? And do you see that following through for the rest of the year? And again, I ask that sort of with a valuation angle, because if, as some people say, UK valuations are cheap, maybe overseas and UK companies see that some of their rivals are cheaper or whatever. So what's the view on that?
Yeah, I think it's been really interesting, this. And certainly, when I think you spoke to Adrian last, we just benefited from a bid for William Hill. And actually, through the latter part of last year, the last 3 or 4 months in the UK was actually a very intense period of M&A. One of the busiest periods we've seen, actually. I think there was over 50 billion of inbound M&A into the UK market, businesses like RSA, Signature Aviation, G4S and Agreco, just to name a few, were bid for by overseas trade or private equity buyers. And truthfully, we thought that would continue into 2021, but actually it's been a little bit quieter. And that's interesting. And why is that? Well, we've clearly had Brexit, which has spurred to some extent a rally in sterling. Combine that with the market moves that we've seen, and the UK market's actually kept up with other developed markets for the first time in a long time over the last 3 to 6 months, which is a very welcome development. So I think when you combine those two things, these assets have gone up in price to these acquirers, and I think that's probably causing just a bit of digestion analysis. But to your point that you made about overseas ratings and valuations, when we look at the UK market, we believe it offers very attractive returns from a cash flow multiple perspective in an absolute sense. But more importantly, in a relative sense, very much so. If we look at some of the businesses that we own in areas such as tech, Sage, for example, in data services, the London Stock Exchange Group, Walters, RELX, DMGT, those businesses are on big discounts to US peers, companies like MSCI and Verisk. And we think that's anomalous because those businesses have very similar characteristics in terms of growth profile and cash generation. And we think, M&A will move up the agenda again as the year progresses.
Andy, Nick, thank you very much. Maybe a summary from me. Dividends being reinstated, reasonable valuations in the UK market, and some relative cheap valuations, which maybe makes the UK look the place to be. I have to say I would agree with most of those points as we sit today. So if you would like further information on the Artemis Income Fund, please visit fundcalibre.com.